Welcome to episode 33 of the Cashflow Connections podcast. The topic for today is how Michael Blank writes offers, communicates with investors, and raises millions. This is a really interesting episode because we cover a significant amount of ground in the conversation. The first thing we talk about is what Michael calls the 10-minute offer. Essentially, one mistake some new investors make is thinking that they have to underwrite the entire deal before submitting an offer to a broker. But this will significantly limit the amount of volume you can achieve as an investor. So we're going to talk about how to expedite that process in order to really see as many deals as possible and really put out feelers on different deals to find out where the sellers really are in terms of their motivation to sell. We're also going to talk about raising capital. Regardless of how much money you start with, if you're a successful real estate investor at any level of scale, this is a skill you have to be able to learn. You have to be able to effectively communicate with investors in order to raise capital. So we're going to walk through this process, which Michael Blank and his students use to raise millions of dollars for their multifamily offerings. And lastly, we're going to discuss how Michael stays motivated, constantly generates quality content. He is an animal when it comes to this stuff. It's all over blogs, all over podcasts, etc., as well as some advice he has for young real estate entrepreneurs. Now, before we jump into the episode, just a reminder, if you are looking for unique quality real estate investments in non-competitive asset classes particularly, make sure you have signed up for an account with cashflowconnections.com. I was speaking recently with someone about my overall thesis, and they were surprised that we were still seeing consistent deal flow. Part of this is due to our focus in mobile home parks and self-storage facilities. These asset classes are unique for a lot of reasons, but one reason in particular that there's still a significant amount of potential is because the purchase prices of these asset classes aren't usually high enough to attract the same institutional capital as something like multifamily. For example, most self-storage facilities we look at top out at about $15 million purchase prices. So if you're Blackstone and you have a $100 million fund and you're leveraging 3-to-1, so you have about a $300 million of purchasing to do, if you were to purchase only self-storage facilities, this would take a significant amount of time or it would take a lot of resources to accomplish that. As opposed to multifamily, you could buy a $50 million multifamily property and really make a significant dent in that with just one transaction. Anyway, long story short, we're still seeing significant deal flow through our sponsors, and we'd love to help you diversify into these recession-resistant asset classes. So go to cashflowconnections.com and sign up as an accredited investor, and we will get you started as soon as possible. Hope you enjoy the episode. How's it going, everyone? Our guest for today is Michael Blank, who is a full-time entrepreneur, investor, and real estate coach. Michael is the founder of Nighthawk Equity, which controls $65 million of performing multifamily assets all over the U.S. Through his coaching program, Michael helps his clients achieve financial freedom in 3 to 5 years through identifying, investing in, and holding apartments. In fact, his students have purchased more than 750 units and are on track to purchase an additional 1,000 in the next 12 months. Michael provides a significant amount of valuable content on his free website, themichaelblank.com, and as well as his podcast, Apartment Building Investing with Michael Blank. He's a regular contributor to Bigger Pockets, as well as Flip Nerd's REI Classroom. So, Michael, really appreciate you coming on. Thanks again.
Yeah, my pleasure. It's great to be here. Thank you so much.
Yeah, absolutely. So before we jump into the nuts and bolts of the conversation today, which is going to be about underwriting, and I also want to get your perspective on capital raising as well. Let's start from a big picture. Tell us a little bit about your background and what you were doing before you started in commercial real estate.
Yeah, I mean, I had a very quote traditional path because I didn't know any better. I just taught to go to school, get good grades, get a good job, and that's what I did. I ended up getting a master's degree in computer science. I'm a highly educated hunter, and
Right.
started off being a programmer, worked at AOL for a little while, and then joined a software startup. And I mean, I didn't get into anything else until I was in my mid-30s. When I read Rich Dad Poor Dad, and I was like, oh my gosh, I am such an idiot. It's not how much money you have in the bank, how much money you're making, it's how much money you're getting from passive income. And it really shifted the ground underneath me. And at that point, while I had certain other plans at the time, which included being the CEO of a software company, I kind of put that whole thing on hold, reevaluated the whole thing, and then decided to throw it all away and really pursue real estate and a cash flow business, which in the cash flow business side was a restaurant franchise, which was a good idea at the time, and that was my big idea. Hunter was passive income through restaurants, and it worked well for about 5 or 6 years, and then started becoming unhinged to the point where I had lost like 95% of the income, the net worth that I had built up through the software IPO from earlier, and so that experiment didn't go very well for me at all. And on the real estate side, things went a lot better.
Wow. I first of all, I appreciate you sharing that story. That's incredibly fascinating. I just can't imagine what that must have been like. So just to clarify, the restaurant business was successful, but the tech side of things was extremely volatile. Is that what the takeaway there was?
The tech side, no, I had actually quit my job to pursue investing full time. Or when I say investing, I quit my job to pursue passive income and retirement full time. And my big idea was restaurants, and I dabbled with real estate at the time, but my big idea was a series of franchise restaurants. And then
Okay.
I flipped some houses early on. I had a couple rentals, and I didn't really get started with real estate until probably after the recession. Once I licked my wounds a little bit from the restaurants, things had stabilized a little bit, and then when I got into real estate, but it was with flipping houses how I got started.
What was it about? What was the key takeaway from Rich Dad that really motivated you? It's fascinating because that book is so influential, but the overall push is very rather straightforward. What was really kind of the motivating factor there when you were reading that book?
I think when you get in I'm looking at the judging people who I speak to and come to me for apartment building investing. And really the person is a primary breadwinner in their mid 30s who have already had 15, whatever years of work under their belt. And they're just starting to reflect on their second half of life. And they're like, man, I can't do this another 20 years. I'm already working 50 plus hours a week. I come home, I'm tired, and then I, help put the kids to bed and then kind of crash in front of the TV and get up the next morning, do it again the next day. And the weekend I do my chores and just, try to recuperate so I can do it all over again on Monday. And it's insanity. And the frustration for me, as well as many others, is very high that I can't control my time. Someone else does. I can't control my time, but I have to take the responsibility that I'm providing for my family very seriously. I mean, everybody does, but I can't reconcile the two. I couldn't figure out how to control my time and provide for my family. So when I read that book, I was like, wow, that's a solution. And that's
Hmm.
what I went after.
Yeah, that makes total sense. And so, how has your investment strategy changed in those first initial days till now?
Well, considerably. My pursuit of financial freedom was very rocky. First of all, I had a bunch of money from a software IPO, so I kind of figured out my first retirement. Kind of took the pressure off a little bit. But after reading Rich Dad Poor Dad, I wanted to parlay that into passive income, and so my second big idea was these restaurants. So, like I said, that was my first idea. After that, not working out very well on the real estate side, I've really tried every strategy under sun. The probably the most I've done was probably flipping houses, but I've negotiated short sales for about a year and a half. I had some rentals. I did some lease options. And I also got into apartment building. So looking at all these things, I made some good money on the single family house investing across the board. But with flipping, for example, it has a fundamental flaw. If I'm not buying, fixing, and selling, I'm not making money. And yes, I read all the books. I had my team in place, so I was doing the quote 4-hour work week. It was still very complex operation. And worst is once I sold the house, there was no more money to be had from that. And that didn't appeal to me. Then I said, "Oh, I know what. Why don't I just do buy and hold rentals? That'll solve that problem." I said, "Look, if I want to generate $10,000 per month in income, and I can buy a rental property that cash flows $200, which by the way is hard to do in most parts of the country, but if I could, I would need 50 houses, and it took me 3 years to flip 36 houses." And I'm like, good grief, how long will that take me? And how much work will it be to get there? And I just kind of went, my gosh, thinking like 5 to 10 years, which isn't really too bad. But I was like, man, there's got to be a better way. And that's when I looked at my apartment building that I had. I kind of sort of got in accidentally. I'm like, apartment buildings, yeah. What's the problem with that? Well, that's actually pretty good. I can scale it. I can probably get to 10,000 per month, and probably at 3 deals or so, 3, 4 deals maybe. That seems to be a way to go. But I had two problems. I didn't have the experience for it. I thought I did with single family houses, and as I got going, it turns out that I got no credit for my house flipping at all. Brokers were like, "Yeah, Michael, but what'd you do on the apartment? How many apartments have you done?" I was like, "Well, I haven't, but I flipped all these houses. Look at that." and no one would take me seriously. And the second problem is I had, which I had when I started flipping houses, was I had no more of my own capital because I deployed it all in the restaurants and it was all kind of deployed. And so I was forced to kind of start raising money. And so those are the two problems I had. And I discovered techniques to overcome my lack of experience, using the right words and build a team around that. And on the lack of money, I just started figuring out how to raise money. And today I have kind of systems for both of these that help people overcome those two main challenges very quickly, so they can get started with apartment buildings right now and don't have to spend 5 or 10 years flipping houses or building a rental portfolio.
Yeah, yeah, I appreciate the explanation there, and it's a really a interesting story because you'll find that it's very rare that people go from apartments to single family houses, and it's common that they go the other way. And so I think what part of the value add that you're bringing to the table is saying, look, you don't have to you don't have to spend as much time going through those single family houses flip days as I did, or many of the other people that I'm sure that your clients look up to did, in order to get where you're trying to go. Because multifamily apartments, commercial real estate in general, the syndicated model, it provides such a more direct access to that cash flow. So that makes total sense. I noticed that, first of all, I want to commend you for the amount of content you have put out on the internet. Really great videos, a lot of really intriguing and detail-oriented stuff. And one of the videos that I saw that you did was the 10-minute offer. I was wondering if you could briefly walk us through that process, how you came up with that, and what that process really entails.
Well, I came up with it because when I got started with apartment buildings, this was back in 2007. I took a boot camp, and like I said, I was just a student of passive income. I mean, I learned how to trade stocks and options, did the house flipping thing, and then also did this apartment building thing. And I just got really into it. And for 9 months, was making offers on property in Texas at the time, and I'm in Virginia, so we're looking for in Texas, that was a great market to buy. And it took me 4 hours to analyze a deal and answer the question, what is the most I would pay for this property and why? And it was so frustrating for me. There wasn't really any tools out there or techniques. The boot camp I took it wasn't really that useful. It was too simplistic almost in a way. And it took me way too long to answer that question. It was so time consuming that I almost gave up because it was so insurmountable. And I knew with real estate, it's a numbers game. The more offers you make, the more deals you can try to get done. And over the years, I've kind of developed this 10-minute offer technique. Both now because I have the better tools, which is what I call the syndicated deal analyzer, which is a spreadsheet that makes this possible, and also allows you to do very sophisticated modeling as you get farther and farther into the deal. But in the beginning, you don't need to do sophisticated modeling because you're trying to figure out what's the ballpark price. And is there any motivation on the seller's part? And if there isn't, then there's no need for you to spend hours and hours researching a deal, which is what I was doing. I was spending way too much time up front researching a deal that at the end of the day, the offer price was too low, and I never got a call back. So I just wasted 4 hours of my life doing that. So it's a combination of technique and tools, but in a nutshell, is you're using the numbers that are supplied to you by the broker. And brokers only talk about in terms of NOI, or net operating income, or income in general. They understand cap rate and price, right? Those are the three levels. That's the world that they operate in. They don't really care how much you pay your investors, or an acquisition fee, or this, that, and the other thing, or your return. Frankly, they that's the numbers they operate in. So I was trying to figure out how can I articulate and first offer to them in those terms. And the 10-minute offer really takes the information that's provided in almost all marketing package, which is normally a pro forma or actual income, expenses, net operating income, and a price. And sometimes if they're overachievers, they'll put the actual cap rate in there, but that's easily deduced, right? So the formula in the commercial real estate world is, value or price equals the net operating income, or NOI, divided by the cap rate. So value equals NOI divided by cap rate. Now, the cap rate, you'll probably ask me next what the cap rate is. Should I describe that a little bit, or your listeners know what a cap rate is?
Yeah, they'll be familiar with what a cap rate is.
All right, great. So really, what you take the income that's reported in that package, and you apply some rules of thumb to it, right? So you look at the income, and there's this gross, potential rent, and there's normally a vacancy factor, and a lot of marketing packages will put like 5% in there, 3%. Well, a good rule of thumb is actually 10%, and it really depends on obviously the market and the kind of property it is. But really, with vacancy and bad debt and some concessions and things of that nature, by the time you're said and done, you're probably going to have lost 10% of that income. So a good rule of thumb really is 10% of that gross potential income. So you adjust that, okay, and then you look at the expenses. And the expenses typically are 50 to 60% of the income is normally where your expenses are. And very many marketing packages will report, 38% or 42% or something far under 50%. And I like using 55% just to be a little on the conservative side. So what you do is you throw out the expense number. In fact, you just throw out all the expenses that are reported in there. You just apply, let's say the 50% rule, just to keep it simple. The 50% rule, and you take your net income and you divide it in half, and those are your expenses, right? So now what you've done is you've adjusted the income, you've adjusted the expenses, and of course, as a result, now you have an adjusted NOI. Then you apply the cap rate that's in the package. Let's say they're advertising it at a 8 cap or whatever. This is an 8 cap property. And you're like, well, you know what? That's great because it meets my requirements. That's fantastic.
Yeah.
And you take that 8 cap and you apply it to your adjusted NOI, and of course, out drops an adjusted price, which typically is going to be lower than the asking price. So very quickly, and you can do some refinements based on that. But what the idea here is, you get a marketing package, and very quickly, within a few minutes, or certainly within the same day, you can call that broker back and have a conversation that goes something like this. Hey, Sam, listen, I appreciate you sending this over. It really seems to fit my profile. It's a value add deal. It's around an 8 cap. It's great, fantastic. But, I looked at your income. It was a little high. You're looking at vacancy rate of 5%. And I adjusted it to my experience is 10%. I'll go, they'll grumble, and I'll go, okay, fine. Then your expenses, they look a little low. I haven't drilled into it a lot, but they're only like 38% of income. Typically, in my experience, they're between 50 and 55%, especially if the owner pays some utilities. So Sam, I don't know what's missing there. Something's missing. All I know, they're low. So I've just adjusted those expenses to 50%, and out drops a revised NOI of X, Y, and Z. And so the 8 cap that you have in there, which is great, if I apply that 8 cap to the NOI, the value is now 900 instead of the asking price of 1.1. Is that something that the seller would consider, or probably not? Now, you've done several things now. First of all, you didn't spend more than a few minutes, quote, analyzing this deal and making an offer. And number two, you have already now made an offer. In fact, that conversation was an offer. It doesn't always have to be in a form of letter intent or contract. You just made an offer. And if the broker then doesn't get back to you, obviously there's no motivation. If the broker invites you to put something in writing, you got a live one. And now you can go a little next level deeper, but not in the very beginning. And that, in a nutshell, is a 10-minute offer.
Yeah, I appreciate you explaining that there. And I think that the key there, probably the most interesting part, is I have received plenty of packages like this, and the aggressive cap rate, which brokers are using as an advertising mechanism, really bites them, because the more aggressive the cap rate is that they're advertising, the more of a discount you're going to give yourself when you adjust that NOI. And that's how the conversation starts. So then it's like, okay, look, you came to me with an 8 cap. That's for sure in my criteria. Based on that, here's the new offer. And so your negotiation tactics it start in your favor. And I think to your point, this is the way to be able to effectively complete the volume that's necessary for you to actually do deals on a consistent basis. Because if you're going through and running every single metric and going through citydata.com and going through phase ones and stuff like that on every single deal, you're not going to be able to accomplish the volume that's really necessary in the game of commercial real estate. Speaking of that, what is your deal flow looking like right now? I mean, when you're getting deals, are they typically from brokers? Do you find that your deals that are from brokers end up resulting in closes? How are you sourcing that whole process?
Well, the way I'm doing it now is a little different, just where I am right now, because we teach people how to syndicate apartment building deals, and through that process, through the online training and the coaching, we also have a joint venture process or a partnering process where people can find deals and they learn how to analyze the deal properly, and they can bring it to us. And the idea is that if we find a deal that meets our criteria, we can then partner with those students and raise all of the equity for those students. And so that's how we're sourcing all the deals, which is, yeah, obviously, number one, a source for deals, but it's also part of my mission, which is to help people become financially free with real estate, specifically with apartment buildings. So we're keeping the student in the deal so they experience what it's like to be in a deal, and they have a track record so that the second time around, hopefully they don't need us, or maybe they do need us. It really depends. It really is up to them. But we're sourcing all the deals in that way right now.
Okay, cool. And that's actually a great segue into this next conversation, which is raising capital. It's obviously a big part of your business now, particularly if it's set up the way that you just kind of described. So, let's start from the very beginning of this capital raising process. What are some of the tips, some of the strategies you utilize when really initiating that first conversation with potential investors?
I think before we can get to that, Hunter, it's people have to believe that it's possible. Number one, some people don't even know it's possible, or some people that think it might be possible don't know why in the world someone would even give them any money, and they feel uncomfortable with that. And I remember when I was thinking about flipping houses, and I didn't have any of my own capital anymore. I just started talking to some friends and family, and there was someone dumb enough to invest $25,000 with me. It was like a 12% note, six month term, and I was like, huh. That's interesting. Maybe I can get another one. And I got another one. And I'm like, maybe I'm onto something here. And it's like this big light bulb went off. And it was just kind of through trial and error. But what we're trying to do is really try to show people that it's not just possible, but done all the time. And in fact, you're doing a disservice to the people around you by not connecting them with opportunities. Here's the thing. Someone with money has two problems. One is they're not getting a reasonable return with the right risk profile on their money, number one. And number two, they're paying too much taxes. And real estate solves both of those problems very nicely to them. It has a very low risk profile given basically any other business in the world you can think of: software, restaurants, nightclubs, whatever, oil drilling, right? A very attractive risk profile. The returns are far above average, what you get in the stock market. And the tax benefits are outrageous. I mean, typically, we'll do a cost segregation analysis where we can accelerate the depreciation, which is essentially a paper expense. Not to confuse the listener here. The bottom line is this: any kind of cash flows that are distributed to the investor are probably extremely low, or not at all, depending on the deal itself. And there's hardly any other investment like that out there. So tax benefits are huge. So you not connecting a person with an opportunity like this, you're doing them a disservice. So you shouldn't feel uncomfortable with that, or feel like you're bugging people about it. You're actually doing them a service. So that's the first thing. And the fact that this is actually possible, that you can actually take someone's money, put it in an acceptable risk vehicle like real estate, and make them a really good return, not only cash flow wise, but net worth wise, right? So just wrapping your mind around that first is really important, because if you don't have that confidence, it makes everything else very difficult or even impossible. So I just want to say that up front.
Very good point. Very fair point.
I think your question was, well, how do you kind of get started? The way I like to talk about is not so much that you're out there raising money. You're really out there building relationships, but maybe in a more intentional way. So instead of you shooting the breeze about sports or the weather, okay, you might share your new excitement around apartment buildings. Hey, you're not going to believe what I'm doing. I got this mentor and group of people, and we're looking for apartment buildings. And minimum investment is $50,000. The returns are between 13 or 15% average annual return. And we're just really excited about that. Would you, and I'm just looking for people to kind of give me feedback on that, or to support me in that, or whatever the case may be. So you're not out there raising money. You're just sharing your enthusiasm about it. And you're really looking for support in general, which could entail, a mentor. It could be referrals to attorneys or brokers, or it could be money. Or if someone doesn't have money, they might be able to refer them to their boss or their brother, or whatever the case may be. So really, it's building relationships in a more intentional manner. And that's really kind of where it starts. And you only begin raising money once the relationship is at that point, right? So if you know someone at work who you think might have some money, and they don't know you in the context of real estate investing, well, you can't go to them and say, "Hey, Frank, hey, I'm raising money for an apartment building. Are you in for 100,000?" They're gonna look at you and go, "What in Utah? No, go away. I don't understand what you just said to me." Right? So you got to build that relationship with that person so they know you in the context of real estate investing over time. And if they're indicating that they're interested in learning more, then you can set up a meeting. And that's kind of the progression early on, is that you're really building relationships more intentionally towards that, and sharing your enthusiasm and garnering support for what you're doing.
Sure. And I think that part of what you touched on that's important there is, particularly if you're working with a mentor, this is a great way to leverage someone else's track record with your network. So for example, if you're going to an investor meeting, one of the first questions they're going to ask is, what's your track record in this business? And so when you're partnering with a team that has a lot of experience, it's easy to say, I'm actually just facilitating, these conversations because I'm working with someone who's done this. Let's say, for example, $65 million in multifamily assets. That's a significant amount of capital, and that sounds like a lot of money, and it sounds like a big track record. It's much more verifiable than someone who's just saying, I'm just getting into this. So if you're partnering with someone that can establish that credibility, it's going to make your capital raising process a lot easier. Trust me, I know I've done both. So that's kind of there. Do you have anything else that you want to add in terms of establishing a track record, or is that kind of what you suggest your students do in terms of leveraging a mentor's track record?
Well, we actually skipped that step because I wouldn't start raising money until I've knocked that off, right? So you asked me about it, but but establishing your quote track record is important before you go out into the world, because people won't take you seriously if you don't. So investors won't take you seriously, brokers won't return your phone calls. So in the under the category of how do you get started, that's got to be one of the first things that you do, is not only obviously educating yourself so you're using the right language, but really building the team around you. Because what you want to do is, when you don't have any track record, you don't really want to talk about the lack of track record. You want to talk about all of the experience your team brings, right? So when someone might ask you, hey, my gosh, what have you done? And goes, you know what? I have this fantastic team around me. I got Susan over there managing 5,000 units. Oh, Susan, yeah, she's great. Yeah, I know her great. Yeah, and I got Bob over here. He's going to be handling closing. Bob, oh, he's great. I've done 4 transactions with him already. And all of a sudden, you have this major team around you who are very experienced professionals, so that the focus is basically off you and onto your team. And it addresses these track record problems if they even come up, which they most likely will not. If you're using the right language, in our experience, you won't even be asked about the track record because of the right language. But if you are asked about it, you're always talking to about yourself in the team. And when someone does want to invest money with you, right, they're going to look at not just the deal itself, but they're going to look at you and your team. And at that point, it's very important that you have a strong team in place that gives confidence to the investor, especially if you yourself don't have a track record.
Okay. And, so one of the major hurdles that I have found in sending people out looking for new deals is that they're worried that if they actually succeed in getting a deal under contract, getting an offer accepted, that they're then going to be in a really awkward position because they haven't gone through and raised the capital, et cetera. What do you kind of suggest for people that are struggling with that major hurdle?
Yeah, it's a real major challenge, right? Like you said, you're lucky someone actually accepts your offer, and you're like, oh shoot, now what do I do? And now I got to go raise the money. I got 60 days to do it, and you're like, how can I do this? And it's very challenging. I mean, it's almost impossible. On the other hand, if I don't have a deal, then I can't go out and raise money. So people kind of throw their hands up and go, I can't solve this problem, can't be done. I'm just going to go back to flipping houses, and I have a solution for that, Hunter. You want to hear it?
Yes.
Yeah, so it's called the sample deal package. It's called a sample deal package, right? And so basically, it's an investor package about a real deal. It's got real photos. It's a real business plan. It's got some real financials. It's got maybe even some quote real projections. The only thing that's not real about it is that you don't have it under contract. It's not actually your deal. Now, you tell people that you don't have it under contract, but you use it as a conversation piece with potential investors. So if someone's showing interest. Just an example, my dentist, what's new, goes, oh gosh, I'm getting this apartment building deal. I'm looking for investors, great returns. I'm looking for investors. And he goes, oh, that's interesting. Can you tell me more? And you set up, a lunch meeting with that person, and you use this as a conversation piece. So you use it to answer their major questions, address their objections about you, about multifamily, about this particular deal, and you get all that stuff out of the way. And your goal really is to get a verbal commitment from this investor. Let's say it's $100,000, and they'll say, look, if you find a deal that looks like this, structured in this way with these kind of returns, I'd be very interested for the minimum of $100,000. So let's say 1, 2, 3, whatever months go by, and you stay in touch with that investor, and then all of a sudden, boom, you get this deal under contract, and you tell your investor, here's the actual deal package. They've already seen something that looks a lot like it. They might have a couple of questions, but nothing major. And within a few days, you can have the money raised. And what that does is really, if you can get verbal commitments like that long before you get a deal under contract, it really gives you a lot of confidence to make offers. Right? If you're going on a $1.5 million deal and you already have $500,000 in commitments, verbal commitments from your investors, doesn't that give you a lot of confidence? Right. And so, wow, now you can make those in confidence. Now in the next 45, 60 days, you will be able to raise that money. Even if one of the investors drops out, you already have the majority of it raised, and it really allows you to raise money much more quickly. So that's really the secret to raising money, is the sample deal package, where you get financial commitments long before you put a deal under contract.
Okay, perfect. And I think I really like that structure, especially because when the potential investor knows that it's not an imminent deal, I feel like that also decreases the uncomfortability of the big ask that may be coming at the end of the conversation, right? So he knows that, you're there to talk about an investment opportunity, but at the same time, the time is of the essence thing is significantly decreased. And so the conversation can be much more educational. And then when the deal actually comes up, he feels calm and educated. And so those questions that you mentioned, they seem to be much more relaxed. And I think that that's a great strategy, similar to what we do as well. You know what? I have a couple of questions that I have for you. I just want to kind of do a quick role play. Like, I will be a potential investor, and you could be a potential capital raiser. Let's say on one of your first conversations, starting out just with your team. Sound good?
Sure.
Okay, cool. So this is a question we get a lot. So if there is a 15% return, this obviously sounds risky given the fact that it's really challenging to return 15% in any type of asset class. So what are your thoughts on this risk return profile given the high returns of this potential investment?
Well, first of all, 50% actually isn't, it's something that we shoot for in all of our deals, but you're right. It is considerably higher than a normal person would get in the stock market, and they'll be perfectly happy with 8 or 10%. And it really depends a little bit on who your investor is. Is it a friends and family, non-sophisticated investor? Is it a more sophisticated investor? The more sophisticated the investor are, the higher the returns they want, because they have access to so much deal flow, and so they're only going to cherry pick the highest ones.
Sure.
So 50% actually isn't really that high. That's really what you're short for. But when you start getting above 20% is when you start getting objections. And it's kind of the rule of thumb. If you get three or more objections from an investor, they're out. They're gone. They're not going to invest, right? So one or two, the investor can kind of, maybe rationalize in their mind, but as soon as they have three objections, they're not likely to invest with you. So your job is to basically address as many objections as possible. And in this particular case, it's not necessarily so much an objection, but it brings up a good point, Hunter, which is when you first meet with a investor, they're not really concerned about their upside and the return. What they're really concerned about is loss of their money. So talking about the downside and the risk is a really important thing to do. And so when someone asks you, "Hey, what are the risks?" and you say, "None. This is all great," that investor should probably run from that investment, because obviously the sponsor or the syndicator doesn't really know what they're doing, right? There's always risks. Now, what we like to do with the investors is, there's always risks. Let me tell you what they are, and let me tell you what we're doing about them, right? So, the risk is not being able to get the rental income that we think we can. But here's what we've done. We've interviewed 3 property managers, right? We've got the target rent, and our pro forma is actually shy of that rent that we're getting, that the building across the street is getting. We don't know what the cap rates or the valuations are going to be in 5 years, but values are probably going to go down. So we're buying this at a 7.5 cap. We're projecting a resale value at a lower valuation in 5 years. We've built in capital reserves of whatever, $50,000 per year, and that's conservative as well. We're going to raise more money than we think we need. And so what you're doing is you're identifying all these risk factors and what you're doing about them, right? We don't want to run out of money, so we're going to raise a little bit more. All of these things, or for example, real estate taxes. We think that the risk is when we buy, the real estate taxes are going to go up, and then we're likely going to appeal them. But we're underwriting or analyzing this deal as if it were 100% or 90% of the sales value based on whatever the tax rate is. And that's worst case scenario, which is not likely to happen, where we're using that in our underwriting and the numbers still work. So that's kind of our approach to identifying risk and what we're doing to appear conservative to the investor.
Well, Michael, I got to tell you, you just knocked out like 3 of my potential questions in this whole role play situation.
Oh,
So I think the strategy works well. One thing we get a lot is what's the chances of fraud, or how do you mitigate the cause of fraud? Because one of the challenges with investing in real estate as opposed to investing in publicly traded companies, obviously fraud happens in publicly traded companies, but the fact that the books are disclosed and there's audits and there's just so much review, it is significantly mitigated that particular risk. What are your thoughts on that whole process?
Yeah, this is a very great question. And obviously, there's things that you can do and look for in a sponsor that will mitigate those. Obviously, if someone wants to commit fraud, they're going to figure out a way to do it. It's just so simple, and it really comes down to character, right? So, who are these guys? Who are the sponsors? Who's in charge? And do you like them? Do you trust them? Look them in the look them in the eye, shake their hand, and sometimes you just don't know. You just don't know. So it comes down to things like, for example, wiring funds to the closing attorney, right? Not wiring it into some kind of personal account or even business account, but wiring it to the closing attorney. The closing attorney then will manage the escrow and then disperse, and everything's going to be in the HUD one. So that's number one, right? So if you're being asked to wire into a business account, unless there's a good explanation for it, and sometimes there's scenarios where that's necessary, but really you're wiring funds, for example, to a closing attorney. Number two is transparency, right? So if I'm asking questions about, and I want to see supporting documentation, let's say I'll make it up, I'm a skeptical investor, and I want to see how you came up with the rent targets. Well, can I see the rent comps? I should say, I'm going to give you the rent comps. In fact, maybe I'll give you a link to the entire Dropbox folder with the entire due diligence, and you can spend 20 hours reviewing all the due diligence documents, right? So transparency is very important. And then 3 is communication. So when we first do a deal, we put out monthly reports, not just, we'll put out a profit and loss balance sheet, but we'll report on income, and we'll have a narrative. We'll talk about the repair. So in other words, communication. And then once the property stabilizes, you can reduce that stabilization to once a quarter or twice a year, whatever the case may be. And here's the key: when things start going wrong is when we start increasing our level of communication. I've been a past investor on deals, and all of a sudden the emails stop coming. You stop responding to phone calls, and you're like, oh shoot, something's up, right? And sure enough, something's up.
Yeah.
And they're basically, they don't want to, it's an uncomfortable conversation, and they just stop communicating. And that's when the investors get angry. And that's when they start calling the SEC and their attorneys. And you don't want that, right? I mean, investors deserve better than that. So regular communication is key. So asking the sponsor about these things, about their transparency, what information they'll provide access to. Also, is how much control can I have as a passive investor? Now, typically, the passive investor has really no control at all. Now, what we've done is we've given the investors more control as limited partners. In other words, they can vote on what happens after year 5. So, for example, one of the things is, well, we're going to sell after year 5, but what if the partners decide not to sell? Well, then the investors are stuck, right? So, and investors really don't want their money tied up for more than 5 years, because that's what you told them. Well, so 5 years come and go, and no one's selling the building. Well, the investors are going to get antsy, but they have no control over it. So the way that we address the control issue is that we let investors vote on the matter after 5 years. If the majority of the limited partners want to sell, they can force us to sell. Same way, they can also vote us off the island, so that they can vote off the general partners for non-performance, again with a majority vote, and they can put someone else in there, right? So it gives them a lot more control, and that's highly unusual, which I understand. But the other one is committing fraud is how much control do I have?
Mm-hmm. Yeah, it makes a lot of sense. And we've actually had a couple of attorneys come and talk to us about the varying amounts of control. And the reality is, well, our perspective kind of on this topic is that when investors invest with us, they're making a bet on us. So we want to have, particularly when it comes to removal of the manager, they 100% need to have the capacity to remove the manager. But also you want to balance that with the fact that investors may not have access to or be able to conduct due diligence on the other investors in the opportunity. So when it comes to things like day-to-day operations, they don't want to give access to the other investors. There may be a large investor that could sway the vote significantly, and that person just has a bad attitude or something like that. So it's always a balancing act. But I appreciate you clarifying that, and definitely agree that control isn't a really important part. It's definitely part of your diligence. You want to focus on that when getting into an investment. So, there's a couple of questions I wanted to wrap up with, just from an entrepreneur perspective, because I know that that's kind of, one of your driving strengths. Um, with all of the content you've put out on the internet, all of the videos, all of the blog posts that you've done, what are some of the strategies that you stay motivated and consistently just dominate in terms of content creation on a regular basis?
Yeah, so it all comes down to really mission, right? So, what my goal is really to help people become financially free with real estate, because, everyone's sitting there in the RIA meeting every single month. They're there for one reason, which is they want to quit their job. And that's why they're there. And like I said, there was the reason I started pursuing this passive income was my inability to both control my time and provide for my family. And I'm not the only one that feels that tension. And what happens is, in myself, for example, when I'm able to solve that, something very interesting happens. When you don't have to work anymore because you have to, your brain starts developing this open space in it, where before it was taken up by work. 95% of your brain was taken up by work and the stress related to things around work. All of a sudden, if that's gone, well, what are you going to put in it? And now you have this new problem where how am I going to use the enormous capacity of my brain, my entire potential, now that the work thing is gone? And that's when people start thinking bigger, more strategically. And
Mm-hmm.
most people start thinking about how they can serve others. Okay, that's kind of happened with me, but I also see it in other people who have left their jobs. Some of those are actually coaches now for us who have quit their jobs, and I see this transition with them also. They're like, they're around their wives. The wives are like, 2 o'clock in the afternoon. What are you doing here? And why are you home? And they're playing with their kids, they're going to recitals, they're traveling a lot. I'm like, Drew, how can you be on vacation again? And so they're enjoying it, but what's happening is now they're asking, what can I do now with my potential? And many people that have achieved that are asking the question not of how can I be successful or more successful, but how can I live a life of significance? So really, at the end of the day, financial freedom really is, in my opinion, not a requirement, but a precursor for living a life of significance. You got to take care of your living expenses. And you can do that by reducing your expenses or by increasing your income, or maybe possibly both. And real estate is just a really great way to address the issue of living expenses. So that's kind of what keeps me going. And, I'm just frustrated by, real estate investors who think they can actually quit their job with single family house investing. And number one, they're not likely to do that, because I've done it and I've thought about it. And a lot of people that have tried it now are coming to me for apartment building investing. And that's frustrating. And number two, they're dismissing apartment buildings for reasons that are actually not even true: lack of experience, lack of money. So this is kind of my message to the millions of real estate investors out there: is you don't really strongly consider apartment buildings as your real estate strategy to become financially free, which then opens you up to live a life of significance.
Love it. You have any advice for young entrepreneurs, just real estate entrepreneurs that are just getting started?
Yeah, just look into it. Again, I mean, don't take what I have to say as as truth, and you might not even believe me, but really look into it. Just strongly consider it, and consider the possibility that you can actually get started with apartment buildings today without experience or with your own money. And if that's something that's interesting, then the first step is to start educating yourself. Number one, once you do that, you can see how it's possible. You might not know all of the details, but at least you can see what's possible or what other people are doing with it. And that will give you a new perspective. Kind of like when I had Rich Dad Poor Dad, I just didn't know these things were even possible. I wasn't exposed to certain information. I didn't know it was ignorance. And then there was other things I thought to be true that aren't true either, right? So this is the case here with single family house investing is ignorance around apartment buildings or what they think they need for apartment buildings. So just looking into it, and that's why, to answer your initial question, that's why I have so much free content out there, is to really educate the masses about what's possible with apartment buildings, and that's what kind of keeps me motivated.
Yeah, it's interesting. I think that's rather straightforward advice, but look, everyone that did it looked into it. So that's got to be the first step. So, all right, before we wrap up, Michael, let's do me a favor and let the listeners know how to get in touch with you.
Yeah, sure. My website is themichaelblanc.com. So it's THE, michaelblanc.com. And like I said, I have a YouTube channel, podcast, blog posts. I have a free ebook there called The Secret to Raising Money to Buy Your First Apartment Building. So that will keep you busy for probably several hours, days. And if you run out of stuff to do, there's also some training material and coaching and in-person events if you choose to go that route.
Perfect. All right. Thanks again, Michael.
My pleasure. Thank you so much.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.